Welcome back to CMG Oral Space lesson. This is a masterclass for candlestick patterns, and we have done a number of them. And hopefully, in fact, this is the last episode of this series. I thought that the recent one was going to be the last one, but because I didn't want to bombard you with a lot of information, I had to stop somewhere and then do the last one. So this is the last episode, and this is a master class for mastering your candlestick patterns. And now, in fact, we have learned a lot of the strategies, a lot of the candlestick patterns, what the candlestick patterns are, and then what they actually do based on where they are actually found on your chart. So whatever we have learned so far, what we are going to do now is what? To do examples, right? Look at some examples, right? So whatever we have learned, we are going to put all of them together and see if we actually remember whatever we have learned. Sorry about the recent video. I think besides the fact that most of the things that we were doing in the recent video was very repetitive, as in we repeated too. In fact, they were very repetitive, right? And it was getting boring. So I decided not to be talking too much. That's why I skipped through most of the reading, and then I was focused on the charts. So that was why. So forgive me, and if you still did not understand it, please watch the previous series, and then you understand whatever I was talking about. So these examples that we are going to look at. Right. So in this section, I will show you different trades examples to help you understand how to trade the market using all the strategies discussed in the previous sections. So let's look at the first example, right? So we said before you take a trade, there are some confluence that you need to look at. You look at the general structure of the market, if it's going down or up. After deciding on that, look at your resistance and your support levels. After looking at that, look at where a candlestick is actually formed at these levels, either at the support level or the resistance level. Then you can or you may continue by using other technical indicators, the simple ones, the moving averages, right? The simple ones are the 21 and then the 8. You use them as dynamic support levels, right? When you cannot actually draw your trend lines in a straight line. So we use them to support us. You can even use them to as in conjunction, the straight lines, as in the support, the resistance, and even the dynamic levels. So that is what we're going to do. So basically, we can say we have our number of confluence. That factors is basically going to be 4 of them, right? And then so that is what we are going to look at. So when you look at this structure, generally, and this pair is actually Euro New Zealand. The euro against the New Zealand dollar. So that is the pair that we are looking at. And then the time frame is 4 hours. That's 4H. That is what is here. 4H. So that is this. So we are assuming that we have done top-down analysis, and then they are all in line with this very particular time frame that we want to trade. And that we call top-down analysis, right? If you don't know what is top-down analysis, go back to the videos. I think episode 14, right? Episode 14 will talks more about top-down analysis. So that is it. So the general market structure is downtrend. The market is moving generally up, down this way, comes this way, and then moves this way and comes this way. So this is a downtrend. So the general structure is a downtrend. So we will draw our resistance, and then the support depends on what we are going to do, right? So when markets are moving down, generally your first resistance level, the horizontal line that you can draw is actually your support. Then when prices move over or past them, then they become what? Your resistance. So that is what it is. So in this general movement, market is moving down. One, we have our support here, first support, and then looking at the first support, let's concentrate on the first support, right? The first support. This is the first support. This is the line, the first support. So looking at that place, we could find first our first entry, right? This is the entry. We drew our support, right? Because price moved down, crossed it, and then came back to hit it again. So the moment you cross it, this support is no more a support, but rather a resistance. So when it gets here, now let's see what happened. A candlestick pattern formed around this resistance level, right? And this candlestick pattern is mainly what? A pin bar. In fact, a bearish one. A bearish one. And then it's like I'm going to go back again and be reminding you. During a downtrend, what should come in mind is what? A sell type of trade. In the downtrend, what should generally come into your mind commonly should be what? A sell. So that is what we are looking at, a sell. And then looking at what happened after crossing and then bouncing back, they got to what? The resistance level. And when you got to that resistance level, what actually formed there was what? A bearish pin bar. So when this pin bar formed, that gives us what? The second, in fact, the third confluence, right? And then the fourth one actually happens with this, the dynamic resistance. It also happened around this space, you see. So within here, there's an intersection. There are things happening within this area. The horizontal line happening there, the bearish pin bar forming there, and then your dynamic resistance also happening there, right? So that is it. And then in fact, the fifth one I can say is what? The Fib retracement, the Fibonacci retracement, right? Price got between this area, right? Was rejected around this area. Look at this wick. The upper tail wick was rejected between the 50 and the 61 moving average. So you see, so looking at all these factors of confluence, it gives us the conviction that we can actually sell here. So if we sold here, if you sold here, wait, let me pick my pencil. Fine. If you sold here, this is what actually happened. Afterwards, we sold here, right? So this is what happened afterwards. So after selling here, this is what happened. So it could be that our SL could be here. Our entry is actually down here because this pattern actually formed. Our entry is actually here. Our TP can be here, right? It can either be on this line also, or in fact, you can even make it wider. It depends on what your risk to your reward ratio. It depends on the trader. It's very relative, right? So that is it. I hope this is understood. If you didn't understand, please pause the video, try and ponder over it, or better still, even start the video again, this particular video, play it again, and you get the understanding of it, right? So that is the position that we could actually take on this. So this is the first one. Now, when we come here to, there is another entry, right? Another entry. So now, this, assuming we have profited from this trade, from here, maybe our TP could actually be here, or whatever. Now, there could be another entry here, right? This is another entry. Now, this is our first support, because moving from here, we are still seeing this as our support level. Now, the moment the prices move past that, right, it becomes our resistance. So now our support is a resistance now, with the fact that the prices move over them, right? So that is it. I hope you understand this. You remember this. So price move below, then what do you see? We see a retracement at this point. Now, when the retracement happened here, they got what? Price got rejected here. And then when they got rejected, actually there was a candlestick pattern what? Forming. Right? And this candlestick pattern forming is what? A bearish what? Pin bar. It's a bearish pin bar, right? So if it happens that way, we can only think of what? Sell again, right? Sell again, and then putting our fib on it, and still with what? Our dynamic resistance. We see that here it's around the area. Sometimes it doesn't really have to fall on it, but if it's around it or intersecting it, it gives us what? The confluence what? To what? Take our decision. And then in this case, what we could do is to what? Sell again, right? So cleaning this out, right? Our sell order would actually be placed just after the formation of this candlestick pattern. Our SL could be here, right? And once again, our TP can be here, right? Then we benefit from that. So that is it. So as you can see, in fact, whatever I've said, we are going to describe it here. So I won't talk again. I'm just going to read so that at least you know that whatever I said is not what? Wrong, right? It's just going to give us a confirmation. Now, as you can see in the chart above, the market is trending down, so as the price action trader. So as a price action trader, I will try to follow the trend and look for powerful signals at the most powerful key levels, right? The first signal we got in the pin bar that was rejected from the support level, that became a resistance, right? The support became a resistance. I've said that already. Now, the second factor, that's the support, that's the second factor, the second factor supports our decision to sell the market, right? And this is what? A rejection of the pin bar from the 50% Fibonacci retracement. We have done that. Now, the third factor that encourages us to take this signal is the rejection of the pin bar from the 21 moving average, right? That was acting as a dynamic resistance level. So whatever I said is here. Now, the second signal was an engulfing bar candlestick pattern. As you can see in the chart, this candlestick pattern was formed at a resistance level in line with the direction of the market, right? So we are seeing engulfing, and then I was seeing what? A bearish what? Pin bar. It's the same thing, right? So it's the same thing in the sense that they are all bearish candlesticks, right? So looking at if you should consider one of them, you see, I told you earlier that some of the pairs are what? Only consist of one candlestick. Some consist of two, and then some consist of what? Three, right? So that is it. This is together with it. The two is what? Engulfing, bearish engulfing. But if you should take one individual of them, is what? Bearish pin bar, right? Bearish pin bar, kind of a bearish pin bar. So we are not far from that. We are not seeing anything far from this. So it's the same thing. So I was considering what? Each candlestick, and then the book was considering what? The pair. So that is it. You see here, what the one candlestick was what? Compared, as in was considered, and then here the two was what? Were considered. So that is it. So the first one is describing what this description is describing the first one. So the same way, I think there's no problem here. And then okay. Now wait for a pin bar, right? Okay, I think I'm not wrong. I think I was just confused. We are talking about the first one. You see, in this case, we have two entries here, right? There were two entries here. So we are rather describing this. So we'll go and talk about this later. I think so. So that is why. So I was not wrong, right? So wait for a pin bar. Good, a pin bar, and engulfing. Wait, so that's good. So you can wait for a pin bar, an engulfing bar, an inside bar, or an inside bar force breakup to form near these levels in line with the direction of the market, and then execute your trade. It is not complicated. So now, okay, I think I was confused. So they are talking about each of these candlestick patterns forming should give us what? The confluence. So in this case, we're talking about what? The pin bar, as in the first example, the first entry, right? So it could be this. So what you have to do is either wait for this and engulfing one, a pin bar, or inside force breakout. So that's what we are talking about. So let's see this example too. This is the range bound. What you saw just now was what? An uptrend, or no, it was a downtrend rather. But this is what? A consolidating market, a ranging market. So let's see what happens. So this is moving up, move down, move up, and move down, right? So this is the movement. Now, you can buy at this level, and you can sell at this level, right? Now, when we see this, these are our support level, and this is our resistance level. I think there was a mistake. Pardon the book, right? This should be our support level, and the top should be our resistance level. So that is it. So you can only buy at this level, you can sell here. But you cannot just jump into buying or selling. You have to look at factors of confluence, right? So at this support level, when price goes to the bottom, what do you see at this line, right? This line, at this line, what formed here was what? A harami, a bullish harami. If you have forgotten about that, please check or watch the videos again. This is a bullish harami, right? A bullish harami, the mother and then the baby inside. And then when it happens at the bottom or at the end of a downtrend, in this very level is a downtrend here, just only this line. It's a downtrend. So when it happens at the bottom or at the end of a downtrend, the reverse is what's bound to happen. So it's going to buy. So you can buy here. You can buy just after here. Your SL can be here. The TP can be on this line, this resistance level, right? In the same way, you can sell here because at this resistance level, what formed there was a pin bar, a bearish pin bar. And when you see a bearish pin bar at the resistance level, what you can do is to sell. So this is as simple as that, right? We are just going to read. As you can see in the chart above, the market is trading horizontally between the support and the resistance level. This market is completely different from trending markets, and the strategy to trade it must be different as well, right? You can't use the same strategy like we use in the trending line to trade this one and ranging market. No. Now, in ranging markets, we trade from the boundaries. I mean, from support and resistance levels. Don't try to trade inside the range, right? What it means is that if it's buying, selling, you can't trade in between the lines. It's not advisable to make an entry there. You can either enter at the bottom or at the top. That's what it means. You can't enter between here. You might lose. And even if you can make a profit, the profit will be very minute, very small. You can't use it for anything, right? So it's advisable to catch the move from the onset, right? Just from the beginning. That's the advice that you have to take. Now, in the chart above, we have two powerful signals, right? The first signal was a pin bar that was strongly rejected from the resistance level. And the second signal was an inside bar formed near the support level, right? We have looked at that. This is another example. This is the general trend is what? A downtrend, right? So after looking at the downtrend, you look at your levels, right? This is moving down, generally moving down. So if it's moving down, your line that you can draw are what generally will support what? Support levels that you can draw. If the market is moving down, you can draw what? Your support. right? Now, the moment price moves below them, then they become what? Your resistance, right? So this is the what? The levels that we have drawn. Price has moved down the first one, right? And it's still going. Move the second one, and it's still going. And in fact, you even see a third candle forming here. So in the first example, what is formed here is what? The price moved below, right? And then there was a retracement. Now, when the retracement happened, got into that line, right? What actually happened on that resistance level? What happened was what? A pin bar, and then that is a sell signal. So if you should enter just here, your TP can be here, and then you make it. That's your first entry, because they actually meet on what? The 21 moving average, and then we have the resistance also, and we have your pin bar also forming, and then the general movement is a downtrend. So that is why we are selling, because all these four factors are in line. Then we move to the second entry. We go here also, price move below. So this second initial support has now become a resistance because price has moved below and then moved back. When you go to this line, this is the line. When you go to this line, what happened? There was a pin bar, a very thin bar forming, right? It cut around that line and then also cuts around the dynamic resistance. So it means that we can what? Continue, go ahead and then do our sell. The sell can be around this place. Your SL can be here. Your TP can be around this place. So this is going to happen until you are not seeing any selling signal or sell signal. And then that will be the end of your entries. As simple as that. So as you can see in the chart above, there are three powerful pin bar signals. When the market approaches the 21 moving average, that acts as a resistance level. Sellers reject buyers and form pin bar that gives us a good entry point. So that is it. So we also look at the money management, right? To this kind of strategy, right? We have looked at money management example, first example in the recent previous video, right? So let's see what is going to happen here. Now you have the strategies. You know how, now that you have the strategies, you know how to analyze the market, right? You have the strategies, you know how to analyze the market. You know when to buy, when to sell, and when to exit. You know also when to stay away from the market. That is it. This is important for you as a trader to know, but you are still missing the key to the castle, right? And then the key to the castle is what? The money management plan. The most important thing that traders don't talk about is the money management. They are always talking about the technical analysis, leaving what? Risk management hanging. They don't talk about this, right? In fact, for me as a trader, most of the things that I actually do is psychological aspect or the discipline of this profession, and then the money management too is very important, because you can actually make it in this industry and lose it within a twinkling of an eye. It's very, very easy, and it's very common among traders, right? So that is why you have to learn the technique and then master the money management skills, and then the psychology, right? It's very important. Now, if you trade without money management plan, you are just wasting your time and money, because nothing is going to work for you. Even if you have the most powerful trading system in the world, most traders focus on how to enter the market. They spend months and years looking for the right system. I don't want you to think like then. You should think differently if you want to become a successful trader. Money management, right? This is introductory video or lesson to money management. We are not going to go deep. We're just going to give you just the fair knowledge, the fair idea of what it is, right? So one of the most important components of money management is position sizing, right? We'll talk about this position sizing. What I mean by position sizing is the number of lots that you are risking per trade, right? We'll talk about lots and then contract size, right? They go hand in hand. We also talk about leverage. They also go hand in hand. You have to understand these terms before you can actually trade profitably. Now, all Forex brokers offer mini lots as the default position size. The smallest value for a minimum lot is approximately $1. There are Forex brokers that offer 10 cents for a minimum lot, which represents an opportunity for traders who don't have bigger accounts. They can begin with $250 and they still have chance to grow it. When it comes to position sizing, you should think in terms of dollars, right? Instead of pips. We also introduce you to what is pips, right? In the basic lesson, the basic videos, basic lessons. That this is an intermediate class, so I'm not going to waste time trying to put one level into another level, right? So you watch the basic the basics of what forex trading, and then you come to the intermediate, and then advanced, right? So that is it. Now, when it comes to position sizing, you should think of it in dollars instead of pips, right? Let's just say you are trading 3 mini lots of CAD USD, right? CAD, the Canadian dollar versus the USD dollar. And this means you bought You bought or sold 30 what? 30 worth of what? Of USD dollars, right? I don't want to bore you. You might get confused. Let's read. If the market moves in your favor, you will win an amount of money equal to $3 per pip. So each pip is going to give you what? $3. Now, when you talk of pip, is the movement of price, right? Is the movement of price from one point to another, right? Is the movement of price. So the movement of prices are measured in what? In pips. You look at that. If you make 20 pips, right, you would have profited 60 what? $60, right? You are just multiplying the 3 by the 20, right? Let us break it down. One standard lot is worth about $10 per pip, and 1 mini lot is worth about $1 per pip, and one micro lot, is equal to 10 cents. If you open a mini trading account, you should think in terms of what? Dollars instead of what? Pips. Let's say you put 50 pips stop loss, right? 50 pips stop loss, and 100 pips as what? Take profit, your TP. This means that if the market hits your stop loss, you will lose what? 50 pips, which is worth what? 50 what? Dollars, right? 50 pips is worth what? $50 for the calculation. And if the market hit the profit target, you win what? 100, right? So that is it. Now, the size of your position depends on whether you have a standard or minimum account and how many lots you are trading. This information is important to you because this will help you know how much money you risk on each trade. Risk to reward ratio. I think we have also introduced you to that already. We'll talk about it more, right? So I'm just going to read. I don't want to just end here whilst you know that the PDF is not done. So I'm just reading. You look at them further. Now, the risk to reward ratio concept is what will make you a winner in the long run. Before you enter any trade, you have to know how much money you will win if the market goes in your favor. I've said this already. And how much money you will lose if the market goes against you. So that is what we call proper risk management. You know how much you will lose even before you enter a trade, and then how much you will gain even after the what? If the direction goes in your way. So you are aware of what will happen, right? That is what is called proper risk management. It's as simple as that. Now, if you will risk $100, for example, your profit target should be at least 200. So this will mean that your risk to reward ratio is 1:2. It's as simple as that. You are losing 100, and then if you should gain, you want ×2 of that, of this risk. So that is, let's suppose you took 10 trades with 1:2 risk to reward ratio. In every trade, you risk 100. So if every trade you risk 100, let's see what will happen. You won 5 trades, right? If you won 5 trades, let's see what happens. You lost 5 trades. Wait, you won 5 trades and you lost 5 trades. You will lose $500, but you will also win 1,000. So the benefit is what? $500. I think this is very confusing. It's like the example that we did in the previous video, right? So let me see if I can find a way to explain this. So we have what 10 trades, right? 10 trades that you are taking, and you are risking one. Your risk is 1:2, right? So in every trade you risk what $100, right? So and then they are saying that you won 5 trades. If you won 5 trades, meaning 5. Okay, so risk to reward ratio. That means if you win 1 trade, your risk is going to be like this ×2, right? So per a trade, if you should win, you are going to gain what 200, right? That is what it means. So per each trade, if you should win, right? If you should win, that the money is going to be times this. But if you should lose, it's just 100, because you are risking only what $100 for that. So if you win, it's ×2. That's 200. And then we are saying that you won 5 of the trades. 5 of the trades. There are 10 trades, and you won 5. So if you won 5 times this 200, it's going to be what? 1,000. $1,000. So if you have, yes, $1,000. But if you should lose 5, you are winning 5 and you are losing 5. You see, you are winning 5 and you are losing 5. Yet, if you should lose, because in each trade, if you should lose, it's just 100, and you are losing 5 of them, right? So it will just be 100 by what? The 5, right? Sorry, my 5 is very bad. It looks like 3, right? So 5 is simply going to be what? $500. So you see the calculation. I think you understand it. Very simple. So even if the number of trade, if you should lose and win the same number, yet you still be making profit because of your risk to reward ratio that you are using. So this is very important. Now, here, this is the power of the risk to reward ratio. You shouldn't think that you have to win all your trades to become a successful trader, right? You don't have to win all your trades to be successful. Just a matter of some small wins, and with proper risk to reward ratio, you are good to go. Now, if you can take the advantage of the risk to reward ratio, you will always be profitable in this profession, right? Now, importance of a stop loss. What is a stop loss, right? All good methodologies use what? Stop loss. They all use stops. Every good trader uses what? Uses stop loss. It's very important, because it is the stop loss that is going to automatically cut your losses, so that you don't end up losing all your money, right? So you put stop loss to say that if the position that you want to enter, if it's not going to go in your direction, then when it happens that way, you are risking an amount of money which you are ready to lose. right? Like we're losing 100 and then the 50 in the recent example, right? So that is it. It's very good. So you have to always use stop loss. Bear in mind, as you progress in this profession, you will be tempted. I know this is inevitable. You'll be tempted to enter some positions without SLs, and even in fact without TPs, and that is not advisable because anything could happen. When you are trading, your system could go off. You could have blackouts, power outages, right? Your phone could get missing, right? And then when you have this open position, your laptop could actually be stolen, right? Anything can happen. So why don't you use this automatic limits to cut down your losses and then to even take you out of the trade if you have even gotten enough. So that is why you have to use that. Never enter a trade without SL. You hear this often, not only from me, but from other traders. It's very important. Now, stop loss ensures here. Stop loss insures against what? Usually large loss and has to be used in one way or another. And in fact, an initial stop loss can be placed with your order on the trading platform. The trade will be closed automatically if the stop loss is hit. Like I said, this type of stop loss will allow you to execute your trade and go spend time with your family or friends, right? It's very important. If you put them there, you can actually close your PC, put your phone somewhere. The market, or in fact, the method trader will do the work for you, right? You can spend time with your family. This will help you trade out of your emotion, right? Sometimes screen time can be tempting. It can be what? Disturbing to your emotions, right? You just have to leave your PC and put it somewhere and then go anywhere, go and have fun. Because you know how much money you will lose if the market didn't go in your direction, right? Now, lots of traders use mental stops. When they enter a trade, they don't place a stop loss because they think that the broker will hit their stop loss, which is not true. So many a time, like I said, you'll be tempted to do this, right? Because you think market could move, just come and take you out of the trade and then move in a direction. I know this feeling, and it's true. But then it is not the best practice, right? Because like I said, anything could happen to your PC, anything at all. You could be occupied, forgetting that you are even in a trade can affect you. The reason behind using mental stop is the human psychology, right? Humans hate to lose money. And if you don't accept losing money as part of the game, you will never make money in the market, right? This is a fact. You should plan. You should be emotionally psyched, psychologically psyched, right? You should be aware of these things before you even venture into this, and then before you enter into each trade, right? So that is it. Now, never think of using mental stop because you can't control the market. You can't be sure that the market will do this or that, right? So just leave the market and go your way. Before you enter a trade, calculate how much you win and how much you may lose. Place your stop loss order and your profit target. And forget about your trade. Go somewhere, go and relax. Don't risk what? Don't risk money that you can't afford to lose, right? So that's why I said every trade position that you enter, you should be ready for that amount of money that you are ready to risk. You should be ready, emotionally ready. Now, I got a lot of questions from traders asking me about how much money they need to start what? They need to start trading. First of all, you have to take trading as a business, right? Take trading as a business. You can make money in this business and you can lose it as well. So trading actually is a business. Like the way businesses start and then they collapses, they start and they collapse. It's the same thing with this. You can start and you fail, You start, you fail, you start, you fail. You have to keep doing until you become what? Ready. You become profitable. And this is why you don't have to what? Be gambling. To make sure the money that you are going to enter. In fact, trading is not a gambling. Right? People have this misconception. Right? It is not. So don't treat it as such. If you do that, it will be what? A gambling for you. And for gambling, you know what happens when one gambles. You are not going to make it. You will lose money for a long time. So that is it. Now, the amount of money that you need to start trading depends on the amount of money that you can afford to lose. I hope you understand this paradox, right? Don't borrow money or risk big amounts of money that you can't afford to lose. Borrowing money will not help, especially when you are amateur. I know you'll be tempted. Sometimes you learn, you think you are okay with the psychological and then the technical, and then you think you're ready, but you don't have the money. You'll be tempted to go and borrow. You come and do this. In fact, this thing needs a lot of practice and time. A lot of people come into this and then within months they want to make it. I'm telling you, it could actually take you years before you can actually be what? Profitable. Right? That is it. So bear in mind. So take it slowly, and then you get to the level, right? Now, in the advanced lessons, I'll introduce you to some advantages, some benefits. So if you follow this series, it's going to help you when it comes to the finding your capital, finding your trading trading account. So that is it. Now you will not be able to follow your trading strategy. You will certainly fail. The best thing to do is to start small and try to get as much experience as you can and build slowly your trading account. This is how successful traders become successful, right? So relax, one at a time, one day at a time. Congratulations if you have made it to this point. This is a sign that you are hungry enough to succeed in this business. I've provided you with the most powerful price action strategies that you can use for the rest of your life to make money trading financial markets. Your success as a trader has nothing to do with your educational background, right? Your success as a trader has nothing to do with your educational background. You can be a doctor, you can be a lawyer, you can be a scientist, a physician, or whatever. If you don't follow the rules, you will end up blowing your account, your entire trading account. And this happens a lot of the time, many a time. In fact, a lot people do this. They blow their account up. I have been through before. I am not different from this. You see, when you start, you always, right? I'm sure you may be afraid for me to use the what? The adverb always. But in fact, you will. At one point of your trading life, you will lose. And it's going to affect you emotionally. So that is why it's very important that you learn everything and then taking away your emotions with proper risk management, your psychology, and your skills. Technical analysis, do that very well. Trading is like learning a new skill, right? You must be ready to put in time and effort. Let me give you an example. If you want to get a degree from a university, you have to spend at least 3 years, right? At least 3 years. You wake up every morning, you study hard, you follow up with your classes. And if you are serious enough, right? You are serious enough and disciplined, you get what? You get your degree. So one thing you also keep saying, or in fact, I keep saying is that when you are a student and you enter into the university or the junior high or senior high, whatever, you understand that the school actually has a number of what? Years that you actually have to what? Be in school. And then when you are there, what do? You learn. So why is it that when you come into this profession and you come within some months, you want to make it either hook by hook or crook? I don't know why you think that way. So in the same way, you are very patient and are very, very serious and disciplined in learning your academic, you are doing your academic work. It's the same thing here. So this is what you have to put at the back of your mind, right? That is it. Don't try to beat nature. So that is it. Now, the same thing when it comes to trading. If you are disciplined enough and you put in enough time and effort to learn, you will acquire a skill to feed yourself and your family for the rest of your life. And you will get your financial freedom, right? So you will never think of a day job, right? The regular job that you do. If you can do this very well, in fact, I bet you will not need to do a regular job. Waking up in the morning and then going to job, working 5 hours, 8 hours a day, right? 26 or 24 days a month. You will not need to do this, right? Of course, I'm not saying that those people who do the regular job, having a job, are wasting their time. No, right? You are just you are deciding to do this. In this world, everyone and their calling, right? And the kind of job that they will do to succeed, to feed their family. So if you have decided to do trading, then this is for you. This is what I'm saying. So that is it. Now, some traders spend more than 10 years to find a winning strategy, right? And become profitable. Others spend 20 years without results. So you see what is happening here? I know this can be what? Dancing. This can be discouraging. But that is the fact, right? So don't tell me you come into this profession and then within months you want to make it. You will need to learn, lose, win some until you finally come up with a winning strategy, right? When you say a winning strategy, a strategy that many a time or most often, what does it do? It wins. It doesn't also mean that a winning strategy does not lose anywhere. No. We are talking about what? The probability. So that is it. Now, fortunately, this will not be the case for you, with you, because you have the what? The map. You have the strategy. You will not spend years trying different indicators and strategies, right? So build your own strategy. I will guide you in building that. And then if you actually want to do this, like I said, we have private lessons that we provide. Now, don't get me wrong. It doesn't mean whatever I'm doing here is quite shady or something. No, I'm doing whatever I have to do here. But if you do the private, that's where you can be doing regular classes, and then we have private lessons. And in fact, you understand some of these things in the fastest, in fact, very fast, right? Because for this series that I'm doing online, you see, I have to have time do it regularly, and then it will mean that I have time. If I'm free, I do the videos, right? So if I have someone that I teach, I know you will bear with me that I will I will have to teach the person before I come and do this video series, right? So you should understand me. It is normal. It doesn't mean whatever I'm going to do here is less quality than the other, but just that I'll have more time for the person. I'll spend more time with the person, and then spending more time with me. That means we are going to have good information, quality, and complete information. So that is the fact. Now, so let's see. You have everything you need here. What you will need is time to master these strategies. So give yourself some time and spend as much as you can to learn, because this is the only way to succeed in this business. Now, over time, you will develop these training strategies yourself, right? I'll teach you, I'll guide you, because you will determine what works for you and what doesn't work for you, right? I won't give you my strategy, because my strategy may not work for you, right? I may be what? Your tutor. Let me one fact here. I may be your tutor, right? I may teach you everything, yet you may be profitable than I am. That is the truth. I may be your teacher, I may be your tutor, I'll guide you, I may be your mentor. But when it comes to profit making, you may be making more money than I could ever make. It's just a matter of what actually works for you. You find your niche, right? I may have the skills like I'm teaching, yet I may not have the risk management skills, right? And then the psychology, I may not have that. How I deal with my emotions and how I react when the market does not go my way. I may not have that quality, that strength. So that is the truth. So you see how this works. So I think that will be the end of this video series on candlestick patterns, mastering your candlestick patterns. This is a video series, lessons organized by CMG Aura Space, right? We do a number of teachings. We do mathematics, core and elective. We also provide English grammar, and then we do database teaching, right? We teach with database too, especially the minor databases, right? The Excel, the Access, the SQL, and that. We do that. So if you can look in our bio, in our description, and you can get back to us on whatever you want, right? And then, notwithstanding, I'm a tutor, but I can still learn from anybody else, right? I know some people, some traders or some tutors may have more insight than I do, especially concerning this video, right? So if anything you think I didn't throw more light on, or maybe I got it wrong with the explanation, you can actually write to me, and I can also learn from you. So thank you very much for sticking with us. Please do well to like and subscribe to our channel. I'm Emmanuel. So this will be the end of this series. Thank you. Bye.